Today we will cover some points, or maybe what I should say is I will highlight some of the points coming out of the MPC meeting yesterday, and then, as Wale said, we'll be open to questions after that. So the first thing to note is that inflation has remained within the government range and below its midpoint. So this has been since November of 2017. And in February, it was 4.5%. As we know, this is not news to us, all of you. This has really been driven by food prices, which have been much more favorable, falling in many areas and many commodities, driven by the favorable weather conditions that we have had in the last few months. There is also another trend in here, which is fuel price. And fuel inflation actually has been rising with the global oil prices. Those have been rising, and therefore our price at the pump, and also a second element is the electricity charges also have gone up. So in any event, those two factors have led to the increase in fuel inflation. This is the only component in the consumer basket that actually seems to be sustaining an upward increase, but it is understood why that is happening. Nevertheless, inflation has been well anchored, and we, as I reported a moment ago. The second element I wanted to report to you is, again, as part of the context, the background for the MPC discussion, is that there hasn't been any significant new data on economic output, but the economic output is more or less, or the issues relating to economic output, GDP that is, remain more or less aligned to our conversation last January. So in this case, we know that we recorded in Q1 to Q3 of 2017, we recorded a growth of 4.7%, which compares to 5.7% in Q1 to Q3 of 2016. Clearly, we've been seeing a lot of recovery in agriculture, agricultural products hitting the market and all that. And we continue to project favorable outcome in 2017. As a matter of fact, looking forward in 2018, we remain optimistic about the growth potential, our growth outcome, and we are projecting a growth rate of about 6.2% in 2018. Now, I'll pause here and sort of say that it's true, quite often, we as economists tend to have fascination with numbers. And I'm sure if you remember, there are a lot of discussions about the outcome and the correct number in 2017. This was particularly the case around October of last year. And, but I think in the end we had this cacophony, which I think in the end the numbers are not that different, but somehow we made a huge deal of differences of 0.1%, 0.2% and things like that. The outcomes for 2017 will be out in, I guess, at the end of this month or early next month. It should be at the end of this month.
Middle of next month.
Middle of next month, I'm corrected. So thanks. Middle of next month, that will be the first set of numbers for 2017, actual. Well, and then they'll be revised and things like that. But I guess the point I'm making here is that let's wait for those numbers to see how 2017 really turned out. At this point, the sort of sharpening of the projection or the estimate of 20 2017 doesn't add much value in terms of our policy direction or indeed the discussion. Thirdly, on the external sector, that is the balance of payments. And here the current account, we estimated at 6.4% in 2017. And we project that this will contract, will close to 5.4% of GDP in 2018. Remittances have been very strong, as you know. Last year we had an all-time record of 1.9 billion in 2017, and we expect that that will continue. As a matter of fact, the numbers for January was an all-time record as well. I'm talking of January 2018. Agricultural exports seem to be doing pretty well. Tea, for instance, better prices. And interestingly, travel receipts, this is all the tourism and etc. That also is up 8% in the year to January. So it's doing remarkably well it's doing remarkably well. And I think this is something that we'll talk a bit more about it in a minute. But at the same time, our external reserves are now at an all-time high. We are in the 8.8 billion US dollar range, or US dollars, equivalent to 5.9 months of imports, which, as you know, is a record. It's true, the part of that is related to the inflows that we received just recently related to the government's Eurobond that was floated a few weeks ago. Nevertheless, the flows to the FX market remain quite balanced. So the inflows and outflows remain balanced. And this is why we haven't had much, let's say, perturbations in the FX market. As you have seen in the daily numbers, or for that matter, the numbers that we publish on a regular basis. I want to say a few things about the banking sector. The first of this is that the average liquidity has increased marginally, but increased to 44.6% in February. And this gives us comfort that the liquidity risks are moderating, are falling. That's the liquidity risks in the banking system and more generally the economy. Now, the point with liquidity, the issue is not just the average, it's also the distribution. And this also has been improving, the distribution of liquidity in the system. And that is something that we are not yet done, meaning there's a lot of work that still needs to be done. There's still some sort of segmentation, but those gaps are closing, and we believe that they'll continue to close with our own intervention and so forth. Now, the thing to talk about now is more the credit risks. And I want to spend a bit of time discussing the credit risk in the banking system. So if you don't mind, I'll tear it apart into little bits so we can understand what is behind them. So first, in terms of gross loans, these have fallen. Yes, they have fallen between December and February, December of 2017 and February of 2018, by 17.75 billion Kenya shillings. So they've fallen by about 0.7% during that period. Really, it's interesting that there were two large repayments by some telcos, some consumers, of loans that they had during this period, amounting to 17.5%. So you could say that the decrease, all the decrease, this 17.5 2.75. You could attribute that mainly to the repayment by two players, two institutions in the communications sector. As a matter of fact, if these two institutions, these institutions obviously were making their own decisions as they would, based on their availability of resources that they have and all that. So that was, I mean, there's nothing wrong with that. There's nothing odd about that. But I think the point I would make is that if these two institutions had not made these repayments, then private sector credit would have grown by 2.8% in February, instead of what we have announced, which is 2.1%. So it's important to see that just because of that repayment, we've had, let's say, a moderation of the growth rate from 2.4 in December to actually 2.1 in February. And that is fully attributed to this decline in this repayment, because without the repayment, then the number calculated would have been 2.8%. The other thing to mention is that actually there has been positive growth. I talked about just a decline in the gross loans, but if you look sector by sector, you'd see that some sectors have actually been, loans in some sectors have been growing. And I would mention the increase in financial services and also personal households. Those have been growing reasonably well during December in the period as compared to December last year. So that's on the gross loans. Let's turn our attention to NPLs, non-performing loans. So now we are talking about the gross non-performing loans. And actually, between December last year and February this year, NPLs, gross NPLs, have increased by 18.5 billion Kenya shillings. So yes, increased by that amount. Now it's interesting, if you look at where are they and how are they situated, about a third of this, that's about 6.6 billion Kenya shillings, are in the manufacturing sector. So let's begin there. So a third of it are in the manufacturing sector. The trade sector is 2.7. Personal loans and households, 2 billion. Real estate, 2 billion. So that pretty much covers all the increase in NPLs that I mentioned. And a lot of these are due to the delays in cash inflows, particularly in manufacturing. Cash inflows due to the low business environment that we have been, that they have been facing in that period. So you can say that, yes, it's understandable, but on the other hand, yes, the NPLs have risen. And can this be turned around, meaning can manufacturing actually turn around the NPLs to regular performing loans? And the answer there is yes. If the banks are working with them, it is possible, particularly because the environment, as we mentioned in a moment, the environment has changed dramatically and is definitely very positive, including for manufacturing, trade, and others. So the point again is that the loans are, the NPLs are localized in those sectors that I mentioned, and we see good potential if the commercial banks are working with the borrowers to turn around those NPLs and make them more performing in the near future. Nevertheless, if you then think about the NPLs to gross loans, so gross NPLs to gross loans, which is a standard indicator that you have. This is the NPL ratio, as we call it. Well, so NPLs, the numerator has increased. Gross loans, the denominator has decreased. So it's obvious the number has increased. So it has increased from 10.57 in December to 11.4%, that is, in February. So the increase then is explained as I have, and that's one of the reasons why I intended to go through this in a rather laborious fashion, explaining why gross loans have fallen and also why gross NPLs have risen. Nevertheless, it's clear that credit risk is expected to remain elevated in the near term, and therefore this is something that needs to be monitored both by ourselves and indeed by the respective commercial banks and indeed the particular borrowers in the sector. The other thing that I think we need to bring your attention to is the regular market perception survey. And this we do, as you know, in the first few weeks of the month. And so we did this in the first 2 weeks of March, this month. And it is interesting what we discovered. I think Aloni mentioned two things. The first is that there was virtual unanimity in terms of optimism. Virtual unanimity. And I think the documents that will be given will indicate this. In terms of banks, 100% of them were optimistic about 2018. So there's a lot of optimism in 2018. If you recall last month, rather in January, when we did this, we talked about the, when we talked in January, when we spoke in January, we talked about the increase in positive sentiments, meaning optimism. The level of optimism by banks was at 95%. And the level of optimism by banks in November of 2017 was at 69%. So what we've seen is an increase in this level of optimism, 69%, 95%, 100%. So it's amazing, I think, as we can see. Non-banks, in November of 2017, it was 63%. That is the level of optimism, right? In terms of respondents, how many respondents were optimistic about the outcomes about the economy in 2018? And 63% of them were optimistic. In January, when we did this survey, 90% of them were optimistic. However, in March, 99% of them, 99, right? 99% of them, Sarah, I need a nod. 90, yeah. It's important to know who controls who. Okay, 99% of them were optimistic. So in that sense, it shows the high level of optimism. At the same time, as I explained last time, I think, well, maybe I didn't because this was seen by us later in January, we have been seeing unprecedented interest by investors in our economy. So local investors, but also external investors. So there is a lot of optimism, substantial optimism. Clearly, things are not the same. I would want to say something to quote Chinua Achebe, but that would take me way off course. There is also anecdotal evidence as to how the last few months have gone, talking to business leaders and so forth. But I think the other evidence here is in terms of the forward bookings in the various hotels, and those also in the market perception survey showed substantial or high levels of bookings. It's also in your package. You can look at it there. I want to finish. So let me talk a little more about the decision, just to give some color to the decision that was made. As you know, the MPC decided to lower the CBR, which is the signal rate, by 0.5%. And the background of that is, of course, that they saw inflation as contained and well anchored, so no real concerns there. Also, they saw this very strong expectation of fiscal consolidation. As you know, the National Treasury is putting forward, expects to have an outcome in this fiscal year of, that's a deficit outcome, of 7.2% of GDP. This is from 9.1% the year before. So bringing it down from 9.1 to 7.2 this year, and something in the order of 5.5, 5.7 in next year. So you can see there is a substantial consolidation that is expected. Also, you've seen, as I explained, the current account, the contraction in the current account, I'm talking of external current account deficit, by about 1% of GDP. At the same time, we saw the MPC saw that there remains an output gap in our economy, meaning our actual output is lower by a margin from our lower than the potential output. So you could say potential output is higher, so there is room to increase actual production, actual output to meet or the potential output, or to get close to the potential output, to bring it closer to the potential output. And at the same time, if you recall, the MPC 2 months ago had also signaled that they were seeing room for accommodative policy in the near term. And you could say they already gave this very strong forward guidance to the market, telling them that yes, they do see scope for accommodative monetary policy. So given this, all these considerations, there was obviously, and you'd see, and maybe I should put it a little differently also, which is you can see there will be fiscal consolidation. And in order for the economy to close this output gap, then it really has to be the private sector that picks that up. So in a sense, you can say looking forward, there will be more reliance on the private sector than on the fiscal in terms of, if you're thinking of economic growth. So there we'll have to rebalance away from public sector driven to private sector driven economic growth and so forth. So this in a sense provides an opportunity. These considerations I mentioned, they presented an opportunity to the MPC, and in that sense the MPC did take that opportunity. Now there was a risk, and it is mentioned in the press, in the communique, the press release, and this relates to the interest rate caps. Insofar as the interest rates caps remain as they are today, it really means that the direction of, let's say, a reduction in the CBR rate, the overall impact of that in terms of expanding credit may not be so obvious. And it is possible that we may have a perverse reaction where indeed the lowering of the CBR rate leads to a reduction in the level of credit. I think we explained this last time, and even before, I don't need to go through it again. So there is that risk. But in the circumstances, the MPC felt that this was, while noting the risk, it felt that that is something that can be looked at, monitored carefully as we go forward, because it's still not clear that risk remains. And we'll stand ready to take any action to counter that if it actually began to manifest itself. And so the issue, which was at the end mentioned, of monitoring the developments in the market are that much more relevant. So I want to finish with two other issues, if you may. Here we are. So the first one is where we are with the two institutions that are in receivership, Chase and Imperial Bank, Chase Bank and Imperial Bank. And as you know, again, just slight context, in the case of Chase Bank, we did put this institution through an expression of interest process, and I think I explained last time why is it that we did that. I'm not going to repeat that unless you want me to. And in the end, we came up with a particular institution, SBM, State Bank of Mauritius, and that institution was made an offer for a carve-out of assets and liabilities of Chase Bank. And we announced to you in January that actually we had started that process. We had reached whatever approvals we needed and so forth, agreements. And now the issue was turning it, or rather implementing it from a perspective of implementing that thing. And at that point, we did mention that it is a matter of weeks. And frankly, we expect this to materialize quite quickly. So the process has proceeded. The various, let's say, connections have been made, and we expect that this will be concluded quite quickly. The other one is Imperial Bank. Imperial Bank also was under, remains under receivership, and we also put it in an EOI process, expression of interest process. And I think last time we explained to you that some specific bidders came forward. We selected some, given the criteria that we had put in place, and those ended up looking at the information that was in the virtual data room. Now, they requested, and there was a certain timeline for them to come back to us, but they requested a bit more time to analyze this whole process, which we granted them. And so we are at that point now where we are now finished in terms of their assessments, and we have to make our assessment based on their bids and things like that. So that I also expect there will be some announcement when this is concluded, but that will be also quite soon. So I don't want to say more, except to say that these matters are now in process, as we had said, in terms of the timeline and so forth. There's one other point I want to raise. And this concerns the sovereign bond that was raised by the government in 2018, otherwise known as Eurobond 2. The facts are as follows. It is true that we did receive the funds that came from the Eurobond, and I'll explain this in some detail, not too much, but in some detail. As you all know, that we, as the central bank, opened an account on the 20th of February. This you don't know, but on the 20th of February, we opened an account in an offshore account in Citibank to receive the proceeds of this sovereign bond. That's not surprising. That is the way we had to receive these resources. And indeed, on the 28th of February, the central bank received into this account 1.999, then the other numbers, but that is enough. 1.999. You can remember that as much as I can. billion, US dollars. So 1.999 billion US dollars into that account. So all of it, not a single dollar was missing. So whatever was received came in there directly. Okay? Then on the 12th of March, upon instruction from the National Treasury, we transferred the entire amount, 1.999 billion US dollars, being the proceeds, to the consolidated fund account here, that is the National Treasury account, belonging to the National Treasury, right? All of it. What we did, of course, is to convert it into Kenya shillings. You understand? The account is in Kenya shillings. So we converted it at the going rate and put in there all the Kenya shilling equivalent. Actually, you ask, okay, we as central bank bought the US dollars at the going rate. I hope we understand each other as to the process. So the equivalent is 201.980, if you want to call it, those are billion Kenya shillings. That came 100%. 100%. So every single dollar to the last penny that was in that account was converted to Kenya shillings, and the full amount, I wanted to say, the full amount credited to the government's consolidated fund account. That closes the process. So then the government has the funds in Kenya shillings, and it can use them any whichever way it wants, according to their processes and so forth. And one of the things, of course, would be even making repayments of whatever they want, loans that they have or other things. But I think the point we are making here is that completed the process. After that, it is a different process, right? The process that you all know in terms of how the National Treasury makes its transfers and things like that. Now, just to be absolutely clear, there was actually a rather, I don't know how to carry it, but a story in today's Standard that talked about missing money. Okay? And basically, according to this, according to the article, you can go read it, there was some missing money that was not received, right? Now, the author, I pulled out my calculator and began to calculate. And the author claimed to have found the information in our weekly statistical bulletin, which I have a copy of here, and you have also. So there he's looking, it's a he. He's looking at the official foreign reserves, and there's the March 15th of 8831, and the week before was 7155. These are all US dollars million. Subtracts them, gets a difference of 16776, multiplies that by 101. I'm calculating it, you can do that as well. You get 169. That's how you got to 169. And then calculated the two whatever and said, where's the missing money? I don't know. It's, the point is, you are just looking at two stocks, right? And a lot has happened. We have made repayments. This money doesn't sit here. It's like your own account. It's like your own account. And there's money that when you get paid your salary, you put it in your account, and then you pay for rent, you pay for other things. But that is not the case. And I have already explained to you that every single dollar that came in, actually every single penny that came in has been accounted for in that way. And obviously this is an advanced statement as how things are. But I'm sure when their auditors look at these things, or whoever has power to do this, when they look at it, they'll see that the story is absolutely clear. Okay, I'll stop there and take any questions. Thank you very much for your attention.
My name is Dennis Otieno. I'm from Citizen TV. I know you said you don't want to say much on Chase Bank, but what are these various connections that have been made? Can you just expound on
Various what?
Connections that you're saying have been made, have been concluded
fine.
on Chase Bank SBM transfer? And also, seeing that there have been calls to have the interest rates capping law repealed. For lack of a better word, do you have a formula for a post-interest caps, interest rates capping era for that matter? Thank you.
Okay.
Patrick Ashula from The Standard. From your MPC statement yesterday, I noted that the precautionary arrangement with IMF was slightly lower than the one that you have always reported in your previous statements. Could you please explain the difference? Then on the issue of interest rate cap, the arrangement with the IMF that these rates could be out in the next 6 months. Maybe from your point of view, what gives government the confidence that this is going to happen in the next 6 months, given the procedure that this has to take the route of Parliament?
Right, from this side.
I take this. Thank you. Let's begin with Dennis. Dennis, what I meant by connections, I didn't want to say too much because I had explained it in fair detail last time. But just for your benefit, maybe you weren't here last time. Basically what it is you have, today, you have accounts in CBL, in Chase Bank in Receivership, right? If you are a depositor. So you could have an account there which is live, or you could have the account that is been, your funds could also be held under moratorium, so you don't have access to it. So the carve-out involves those deposits, a portion of those deposits, 75% of those deposits, I'm talking of the moratorium deposits now, being moved over and access being provided to you in SBM, right? You cannot do it one by one because it takes too much time. You have to do it sort of block move. I don't know whether, I mean, a lot of them have to be moved at once, right? So that's really what I'm talking about, the connection. So it is sort of the IT thing of having two systems talk to each other so that they can, let's say, create all these accounts. At the end, what we'll do very shortly, you as a depositor, you'll get a notice which will tell you that on this day, your account, your amount of so much will be available in SBM, in this account, in this manner. So all that has to be done before. So that's the connection I'm talking about. Do you understand, Dennis, what I'm saying? So it is that, I would say, mechanical sort of connection more than anything else. And those things take time. You have to do them carefully. The systems don't always talk to each other correctly. I don't know if you've ever had the tragedy of upgrading your system. I'm talking of anything, Windows or Word and all that. They always tell you to work right away, right? And then, you know, an entire weekend is wasted upgrading it. And you understand what I'm getting at? So it is a mechanical sort of issue. It's not a policy issue. It's just mechanical in terms of that connection. In any event, the prospects are now good, having done all that, and we expect that this will be done. This will be completed shortly, and the announcements will be made. There were two other questions that related to the interest rate amendment to the interest rate environment, really. The amendment to the Banking Act that set caps on lending rates and also a floor on deposit rates. Now, what will happen? I think I want to begin by explaining or again repeating our view as central bank. it's interesting, a lot has been talked, I mean, everybody talks about everyone else, right? What about the central bank? You know, we feel like sort of flower girls, you know. It's not a good expression, right? I don't think any of us want to be a sort of a fifth wheel, particularly if you're the driver of this whole thing, right? I think you understand what I'm saying. No, but we've already made our positions clear, very clear on this, meaning we are talking our opposition to the interest rate caps environment and all that. What is more is that we have been doing a lot of work to explain to actually, let's say, distill the impact of the interest rate caps. I think as we speak now on our website, there's a paper that I promised, and there's a summary also of what we have discovered, right? Meaning what has been the impact of our interest rate caps now, not the theory, but the actual, what is the impact of it directly. There has been others that have written, that have looked at this. For instance, you have the World Bank that wrote a report, or actually a section of a report, back in October, November on this, and it is public, it's available. It is part of their Kenya economic update. And you also have the IMF that also wrote a paper on this and also talked to various entities, various stakeholders while they were here. So the work has been done, and it is there. So the question is, okay, where are we going with this? Our view is very simple. Our view is we need to begin that conversation with stakeholders. And I think I made this point last time. That's why we've put that paper out there. And we expect you to comment on it. We expect other stakeholders to comment on it. And we ourselves will be talking to all the various stakeholders, including Parliament, but particularly Parliament. But they are not the only ones. There's also the bankers, the commercial bankers. They point us to how to remove how these things will be amended and so forth, or be repealed. I don't think that is a foregone conclusion that the only way to do it, to remove it, is by repealing in a particular way. I mean, there are many options, if you understand what I'm getting at. There are many ways of removing it without necessarily going forward with a law that repeals it. You know? For instance, you also know that we're in court. You already know that. We have been sued 3 times on this issue. And we have actually made the claim that we've been very strong in our position, including that we believe that this issue, let's say, thwarts our monetary effectiveness and therefore would really be unconstitutional in terms of the independence issue and so forth. I don't want to ventilate those issues today. I'm just making the point that we are very much front and center of that discussion. How it will be done going forward, that's really a matter for discussion with the various stakeholders. But we didn't want to, let's say, go to them with a sort of what I'll call a principled position, which is what we had done before. Now we are going to them with not just a principled position, but with actual data. Again, going back to this thing of data-driven policy determination. I hope I've answered your question and also answered the other question on this matter. Then there's another one that came up on the IMF standby arrangement, explaining this. And I do hope people from Bloomberg are here. She's here. Thank you, thank you. I do hope they're here. Thank you. I do hope they're here. So my point is the following. I mean, colleagues, this is something that I think was completely misunderstood. And I think we need to be honest about this. But the question is very precise, and I'll answer the question. In effect, what there was is there are 2 arrangements that were, it was a pair, right? A pair, meaning you have 2 different arrangements. In the past, we would only have one. And if you want me to explain some more, please ask later, because this is something we need to understand each other. But when we had the arrangement with this precautionary arrangements, we were using the plural arrangements. It's a pair. So, and the pair is, there are two pockets, if you may, from which we would have drawn these precautionary resources, or the IMF would have provided us with these precautionary resources. And the first one is the precautionary, is the concessional window related to the PGRF, PGRT actually, PGRT. In the olden days it was PGRF, so PGRT. So that window was known as the standby facility, SBF. And this obviously would be concessional if we drew on it, but there was an amount that was available to that. Unfortunately, the rules of that are that you can only have a standby facility for no more than 24 months. So those are the rules from the beginning, no more than 24 months. If, for instance, we had it for 1 month, for 1 year, we could have extended it or renewed it or whatever else it is. So if we had to have another one of those of standby facility, we would have to have a new one, a new arrangement. So let me go back to the pair. So there are two pairs. There's a pair. One is the standby facility, which is concessional, and the other one is the standby SBA, which is standby arrangement, which is non-concessional. So that is the upper credit tranche level, the SBA. I hope Bloomberg is listening. I did this for a living, my friends. So really what you had is those two pairs, right? Now, we had them for 24 months, and that ended, was to end on March 13. That was by design all along. Now, what we have requested is an extension of, you could say, both arrangements. You could say both arrangements, right? But the first one cannot be extended. So there's no way that that would be extended. So that cannot be extended. The second one, which is the SBA, the standby arrangement, which is the non-concessional, that can be extended, and that's what happened. So you only have access, or you'll only have access in that window. Hence, it has stepped overall access, therefore, in our precautionary arrangements. We now only have one arrangement, not two, and you only have resources that is available in that arrangement, and that is why it has come down from about 1.5 to about 1 billion US dollars. So I hope I've explained why the numbers have changed in that way. Now the point, of course, is it has been extended, and access is available to us as before, or rather access to those resources are available to us, conditional on our completing a review. And the expectation is we will then be going to complete a review sometime in June or thereabouts, sometime closer to June of this year. So that is the timing of it. I hope I've clarified this, and if there's any more questions on this, you can feel free to have a follow-up question. Thank you, Alice. The extension has happened. You know, it has happened, right? So that is clear. The issue is access, meaning if we wanted to draw down on it now, it is conditional on completing a review, right? Conditional on completing a review, and we expect to complete that review currently, we expect to complete the review sometime, say, in June, towards June. Now, you ask about reserves. We've never had more reserves than we have today. So what would possess us to go and get more money? We haven't even done, we are at 8.9, right? 8.8 billion. Almost 6 months of import, 6 months cover of imports. Why would we do such a thing now? So I think the point is, I think we get a bit too carried away by access. This, which lever to push and pull. But the whole point is to provide some buffer to exogenous shocks, external shocks. And we are quite comfortable with that. I mean, we have enough reserves to cover us for 6 months without having a single dollar coming in. So I think the point here is we have to understand these are all options we have. Just like you yourself, if you have an insurance cover, you probably think whether you're going to use that insurance cover or not. You understand? Like if you in your car, if you hit something, you actually begin by going to insurance and sort of saying, well, I just hit something and I want you to pay for this. I mean, one needs to have that conversation, that discussion, or rather that assessment more than anything else. So I think the point for me is we are quite comfortable. This is sort of like a second layer of protection. It's always been a second layer of protection, particularly given where we are in terms of reserves. I hope I've answered your question. Thank you. Then we have other questions. Brenda asked the question of risks and things like that coming from the NPLs and credit risk. I think this is, it goes back to the business of banks. Banks are there to lend. That's the business of banks. Their business is not sitting on money to use a sort of lay conversation language on this. Their business is not just to sit on money. Their business is to intermediate. And sure enough, they will intermediate. They get deposits, and then they convert that to long-term lending. That is the whole business of banks. The margin at this and all that, fractional reserve and all that, that is the business of banks. But what happens is banks can be a bit careless. And they may lend, and in a way that may not be, let's say, may not relate to the correct risk of that particular person. So, for instance, they are not assessing risk correctly of the borrower. And I think this is what we are pushing them to do. So, just to be clear, and I think there's an issue I should also come back to on the interest rate caps. Just to be clear, the banks need to assess the borrower's risk correctly. And thereby, so risk assessment is part of the package of how banks do. And thereby present or prefer a certain interest rate to the borrowing interest rate to the borrower. Obviously, the existing loans, it means that the banks need to monitor them much more closely. That's really what it is. So current stock of loans need to be monitored very carefully, and the banks need to work closely with the borrowers to make sure that those loans are being serviced on a regular basis and so forth. And secondly, they have to be more cautious in terms of assessing risk of the borrower. And that is the change that we want to introduce in the banking system. Frankly, the point here is not just having low interest rates. That is not the fundamental issue. The fundamental issue is to have risk-based pricing of loans. So if I'm risky, I should actually pay a certain premium that is related to my risk. If you, on the other hand, are less risky than myself, well, you should actually, for that particular project that you are conducting, the borrowing rate should be consequently lower than that.
When you're saying CBK is going to move when it needs to move, I really need to understand, and you spoke about the measures. I just want to know, are we going to see more easy? What are some of the policies that CBK has perhaps in their report that they're going to? Yes.
Maybe I think I need to clarify a couple of things, if you don't mind. First, I talked a lot more about how commercial banks would react. right? That is really the issue I was trying to get at. So it's more the commercial banks that need to react. We've already now moved the CBR by so much. So it's now commercial banks that need to react and really be providing loans at a lower rate. But based on this risk assessment of the borrower. So I think this is a point I wanted to stress. The central bank has moved, and it has sent this very strong signal to all commercial banks and indeed all borrowers that the economy can benefit from a lower interest rate environment, and therefore commercial banks need to react appropriately. So I just wanted to stress that. Now, at the next MPC, the members will actually also need to make a determination, again, as we do every single meeting, as to the appropriateness of the environment, right? And whether the conditions are right for a movement in that. If, for instance, the conditions are for a further decline, well, the central bank or the MPC will make a determination. If, on the other hand, conditions have changed dramatically, and it is calling for a sort of a tighter environment, then they will react appropriately. But we cannot sort of anticipate what their decisions will be in the future. Today and now, they made that decision based on the information that is before them. What happens in 2 months or wherever else, it's really for them to look at it again. But again, the ball now is in the court of the commercial banks. And they now are the ones that need to take it forward. And also, of course, the borrowers. I hope I've clarified. Thank you.
Yeah, my name is Brian Luki from Nation Media.
Please turn around.
Yeah. I just have brief questions. You have cited unprecedented foreign interest
Into the mic, please. Sorry.
Yeah, in the local economy. What is fueling this? Also, some time back you issued guidelines on how local banks should take steps to ensure that money is not laundered by a section of South Sudanese officials. What further steps have you taken on this? And also, I wanted to know whether banks have complied with some cyber security guidelines you had issued earlier. And also, yeah, I was looking at the numbers. I saw the Deputy Governor recently attained the retirement age. Just wanted to know whether she plans to stay on the long haul or she plans to exit office earlier. And also finally,
Right, those are like 6 questions.
just one last one. You said the Imperial Bank sweethearts have sought to study the books. Who are they and who are their names? Yes.
Right, all the questions.
So 1, 2, 3, 4, 5. Is this it?
That is it. We can't have anymore.
Okay. Imperial Bank, you'll have to be patient like everyone else. So everything has a time and a place. There's a time for everything. There's a time and a place for making those announcements. You will know at the right time. Cybersecurity, sure, yes, there has been, they've been responding, but you have to understand that this is not something, it's like illness. Or if you are one of the people that are having, that the doctor has said you need to exercise. You exercise today, what about tomorrow? You need to go and exercise again, right? So it is it's something that needs to, it's alive. You cannot say you've done it and therefore you park it on the shelf. It's not a finished book. It's something that needs to be done, and we are very conscious of that. I'm sure you all understand that. You talked about money laundering, South Sudanese. There's nothing to add. I mean, we work with banks and we tell them what they need to do. So I don't think I really don't know what else you're expecting me to tell you, because we have already had a communication or conversation with commercial banks. They react appropriately. What else is there to communicate? So no, you're not going to ask the seventh question, please. Unprecedented interest. And yes, okay, this I can explain. I think maybe I missed on something here, because I have, when I saw you last, I went and traveled to Davos. And in that context, there was unprecedented interest. The number of investors that were trying to contact us and explain to us and sort of, have a conversation with us. We have also been meeting with a lot of investors. So, and generally we do that. There's nothing odd about it. What is odd about it is the extent of their interest. There are also others that have been doing the same. And for instance, even some commercial banks have felt that there has been a lot of excitement about Kenya and interest that is coming through. So I think that is how I would want to characterize it. I cannot tell you that we have 200 investors that want to come tomorrow or any of those things. That's not the level of it. It's just, this is a qualitative assessment based on the request and information and so forth. You asked about the DG. I'm a bit, how would I say? Unfortunately, all of us become lawyers, right? This is the Kenyan approach. All of us are lawyers. So I'll just ask you to go check the Gazette notice of 2015, number 4,532. It's a short Gazette notice. Thank you very much.
All right. Thank you, everyone. Sorry, realize my voice is louder than a microphone. Thank you, Governor.
Sure.
And the other members from the Central Bank. I think we can release you now.